Welcome. In this video, we're going to take a high-level view of management accounting in order to provide us with some type of context for understanding the various different topics that we'll be subsequently talking about in this course. So in order to do so, we need to ask the first question, which is, what is accounting? Now, this is a question that I ask my students in every class I teach. I've done this for the past 30 some odd years, and almost inevitably, students they're quiet, they kind of look at each other. They don't really know what to say. This doesn't suggest that they don't know or understand what accounting is. Rather, it suggests that they haven't been forced to articulate what accounting is in a precise and efficient way. So what is accounting? Accounting is keeping track of stuff. Accounting is data capture. It's producing information. All right? So if we're going to have a system whereby we produce information, first we need to understand what are the fundamental components of a system. There are four fundamental components of a system. There's an objective, there's inputs, there's processing of those inputs, and then there's outputs. So for example, you could have an educational system. What's the objective? To produce educated students. What's the input? Students. Processing. They go through the educational process, and there's an educational transformation, and that's the output. So in an information system, our objective is to produce information. Okay? So a very useful thing is to always, when we're trying to understand what something is or define what something is to ask ourselves a couple fundamental questions. Make sure we always understand these things. What are we trying to do? Why are we trying to do it? For whom are we trying to do it? And then how do we do it? So if we're talking about the different types of accounting, financial accounting versus managerial accounting, or even versus tax accounting for that matter, it's very useful to think about it within the context of those items that I just mentioned. Now, before we do that, it's very, very useful to keep this in mind throughout all your business education and your business life for that matter. All businesses engage in three fundamental activities. They operate, in other words, they do whatever they do. We must invest in an infrastructure in order to support those operations, and we must finance that infrastructure. We must finance that investment in assets. The typical, or when we talk about a financial accounting system and we think about the typical outputs of a financial accounting system, which are the financial statements, that's an income statement, a balance sheet, and a statement of cash flow. Well, the income statement is a statement that provides information on how well that company has performed, on how well it has operated, on how well it has done doing what it does. The balance sheet provides information on investment in that company. And the best way to understand this or to think about it is to always think about the accounting equation: assets equals liabilities plus equity. And assets represent the investment that we make in order to support our operations. The liability and equity side of the accounting equation is how we finance those investments. In other words, that's our capital structure. So if we're interested in investing in a company, or we want to know something about a company, what we want to know about are these things. How well has that company performed? What type of assets does it have at its disposal? What type of resources does it have at its disposal? How are those resources financed? Okay, that's your income statement and your balance sheet. And then finally, there's a cash flow statement, which is where did cash come from, the cash that came into our business, and where did cash go, the cash that flowed out of our business. And the cash flow statement is organized according to these three fundamental activities. In other words, we have sources and uses of cash from operations, we have sources and uses of cash from investing, and we have sources and uses of cash from financing activities. Okay, now let's specifically talk about financial accounting and then ultimately managerial accounting. What is the objective of financial accounting? In other words, we're going to answer those questions: what, why, who, and then how. What are we trying to do with financial accounting? Our objective is to measure income and to value assets. We need to measure income, that's our income statement, and asset valuation has to do with our balance sheet. Okay? Why are we trying to do this? Because this information is useful to investors or potential investors, parties that are external to the organization. They don't have the ability to observe what the business does internally, so they rely on reports or on reported information regarding the performance of the organization, the net resources it has available, so forth and so on. All right, so that answers the what, the why, the whom, and then how do we go about doing that? Well, we prepare financial statements. To understand financial accounting, you must always be aware of something that we refer to as a fiduciary relationship or an agent-principal relationship. And this is a case where investors invest in the company, but management oversees the company, runs the company, and is legally supposed to run the company for the benefit of shareholders. This creates a potential problem because management may be inclined to operate for their best interest. You know, the same kind of problem exists in the political realm. In other words, our representatives are supposed to act in our best interest, but they have an incentive to act in their best interest. So there is a similar type, there's an agent-principal relationship there. So when you have an agent-principal relationship, a key thing that you need is how does the principal control the agent? So whereas in financial accounting, the primary objective of financial accounting is to provide useful information for investment decision purposes, a secondary objective of financial accounting is a control function. It's to provide information to existing shareholders to evaluate the performance of management. It's a way of controlling management. We hold management accountable for certain metrics such as net income, earnings per share, return on investment, whatever, and we evaluate their performance vis-a-vis those metrics. All right, what's managerial accounting? Well, again, we're going to ask the same questions. What, why, whom, and how? Well, what are we trying to do in managerial accounting? Well, it's an information system. We're trying to provide information, but that information is to assist management in running the company. It's a significantly different objective than with financial accounting, which is to assist investors, potential investors, in making an investment decision, whether or not to invest in that company vis-a-vis the capital markets. In managerial accounting, the objective is to provide information to assist management. So a couple things that are really important about that. Number one, we're all on the same team. In other words, if management prepares the information, it's preparing it for themselves, and they don't have that agent-principal scenario that you do in financial accounting. A lot of what makes financial accounting very meticulous and pedantic is we must follow very precise rules in how we do things in financial accounting. The reason for that's very simple. The people that prepare the financial statements is the management team. It may be the accountants, but the accountants are part of the management team. In other words, somebody does not come in from the outside and prepare the financial statements of a company. Management prepares those financial statements. Why do they do that? The primary reason is because they understand their company better than anybody else, and they're in the best position to do that. However, they have an incentive to distort that information, specifically the performance aspect of that information. So how do we control for that incentive to distort the information? Well, they have to prepare financial statements in accordance with general accepted accounting principles, or very, very specific rules. And what happens is an external outside party comes in, that's the auditing firm, and they audit those financial statements, and they audit the internal control system of the business to determine whether the financial statements were prepared in accordance with general accepted accounting principles. Now, when we're talking about managerial accounting, we don't have any of that kind of problem. Management can provide any kind of information it wants because it's providing it to itself. So what kind of information does management need? Well, let's identify the basic things that management engages in. Formulation of overall strategies. That's at the top corporate level of the organization. Resource allocation decisions. How are resources going to be allocated within the organization? The oversight of operations, the cost planning and control of operations. Performance evaluation. Once you start to delegate authority within an organization, you create the potential for a principal agent problem. And that brings in the same kind of issue that we have in financial accounting, where we need to have some mechanism whereby the principal can control the agent. So we take a look here at this little diagram. It identifies some of the ways in which financial and managerial accounting differ. Notice up here in the red, that's our accounting system. We capture information, we process that information, and we produce output. The type of output we produce depends on who it is we're producing it for. If we're producing it for financial accounting, then that output is being produced by people external to the organization, primarily current owners and potential owners. That would also include creditors and tax authorities, regulators. Okay. Financial information is highly summarized, and it's focused on past activities. An income statement shows the performance of the past accounting period. Financial accounting information must follow GAAP, and financial accounting information is mandatory. In other words, if a company is listed on a major security exchange, it must file financial statements with the Security Exchange Commission. Now contrast this with managerial accounting. The information is provided for people internal to the organization. So there is no principal-agent relationship. There is no conflict there. The needs, the information needs are quite different. They're not to make investing decisions or oversight of loan arrangements. It's for planning, controlling, running the business, so forth and so on. It's not past-oriented. It's future-oriented. As a manager, I want information that's going to assist me in making upcoming decisions as opposed to evaluating what has happened in the past, which is what we're doing with financial accounting. Whereas financial accounting is highly summarized, managerial accounting must be very, very detailed. For example, and this is a lot of what we'll talk about in the first part of this class, when we talk about inventory in financial accounting, that's a number that goes on the balance sheet, and it has a corresponding number, cost of goods sold, that goes on the income statement. That's a very, very aggregated number. But when we're talking about inventory from the standpoint of management, we're talking about costing our inventory, making decisions about what products to emphasize. There's a whole spew of things we do on the management side for which we need very, very, very detailed information. Finally, managerial accounting is not required to follow GAAP. It's not required to follow any rules for that matter, and it's not mandatory. I often refer to a management accounting system as a cost measurement system, and every cost measurement system must do these 5 different things. And this is also a useful way to think about the various subject matter in a managerial accounting course. First, capture resource consumption. Well, what does that mean? Well, resources are consumed in order to do, let's say we're a manufacturer. We make a product. We consume resources in order to make that product. We want to capture that resource consumption. That's a fancy way of saying we want to accurately cost that product. We operate a division that consumes resources. We want to know what it costs to run that organizational unit. This is the first and the most important objective of an internal cost measurement system. Because if we don't know what things cost, then we can't even begin to make a whole multitude of decisions that are cost dependent. Secondly, we need to facilitate process control. What does that mean? That means we need to get information that will help us improve our processes. Ultimately, cost management is resource management. And what we seek to do is utilize our resources as efficiently and effectively as possible. So how do we become more efficient? How do we become more effective? Well, we have to have information on our operations in order to do that. Support decision making. There's a whole multitude of decision making. This is the part, this is what I often refer to as applied economics. where we're going to make decisions such as should we manufacture a component in-house or should we outsource that component? Should we continue or discontinue a product line? If you want to expand the time horizon, that gets us into capital budgeting decisions. In all of these cases, we need information in order to make those decisions. That information is going to be provided by our cost measurement system. Once we start to delegate authority, then we have a performance evaluation problem. That gets us into an area which we refer to as management control systems. It's analogous to financial accounting because we now have a principal-agent relationship within the organization. We've delegated authority to somebody. We have to have a way of evaluating or of controlling them. And the way that we do it in business is we evaluate their performance. The way you do it in the military, for example, is you tell people, you give an order, you tell people what to do. In business, we give you an objective. You're free to go pursue that objective in whatever way you want, and then you're held accountable for the outcome of some metric related to that objective. And then finally, our internal management accounting system or cost measurement system must value inventory and cost of goods sold in order to prepare financial statements. Now notice that this last objective is of almost no relevance for management. This is information that is necessary for the preparation of financial statements which are provided to parties external to the company. It's not information that is useful to management. However, this information is mandatory. So while it's the least important, it's the only type of information that is absolutely mandatory. Okay, that wraps up our little discussion here on an overview of managerial accounting. See you next time.